I'm very happy to have you, Rob. We know each other. We've done a dinner together years ago in New York. And you guys are doing a special dinner in New York again next week in a different, of course, with a different company, which is what we'll be talking about today. And I think what I think is interesting about our discussion, and I always say that when I have people like yourselves, I find people that had an exit already, that are entrepreneurs that proven they get their space well and were successful navigating it, is a completely different ball game than others. That's I just think it is more interesting and more maybe promising, and maybe the risk is a little bit lower when you're dealing with somebody who's done it several times. So that's just my perspective, of course, of things. So I'm pleased to open this special session with Rob May and Chris Litster, which are entrepreneurs with, I think, $1 billion of exits or involvement behind them, and a vast experience in the AI, tech, and SMB world. And today we're going to talk about your company, Dianthus, a private company that merges software and private equity models into a single business that straddles investments and operating models. We'll talk about it. You'll explain it, of course, better than me. You are able to grow EBITDA 200% at your first acquired company through a combination of omni-channel expertise and applied AI. Now you're scaling in 2022 from $15 million to $100 million in revenue using these same strategies. So just a couple of words about you guys. Rob May, on the right side, I think, of everybody. He's the founder and CTO. He has over 20 years of leading tech startups experience as a founder or CEO. Prior to founding this firm, he was a general partner at PJC, an early stage venture capital firm originally founded by Gina Raimondo, the current Secretary of Commerce. And more, and I'm just giving really the highlights. You, of course, your stories are larger than what I just mentioned. And if you could share that with us when I'm done. Chris Litster is the CEO of the company with over 30 years experience working with the SMBs and enterprises in diverse sectors. Before joining the firm, you were the CEO of Buildem, which was acquired by RealPage in 2019 for $580 million. Prior to that, Chief Revenue Officer of Constant Contact, where he spent 10 years building the business through its $1.2 billion exit to Endurance in February of 2016. So, wow, it's yeah, that's it. That's the best sentence I can come up with after reading your book.
Nice of you.
So I'm so happy to have you with us. Thank you for being here with us today. And maybe we can start by, where are you guys really sitting right now?
I am in Cambridge, Massachusetts at our shared space office, right on near the Charles River.
And that's normally where I am, but I'm actually on vacation today in Tampa, Florida, as you can see outside. And so I'm calling into this because of the special event, but I've had this week off, so.
Lucky you. So you're done.
And I made him take it up. I didn't want to hear from him.
So he's done with this, and he's going to take it easy on the beaches of Florida. Okay, so we don't need, great. So you're enjoying yourself. And sorry, I just noticed that when I shared my video, it wasn't shared, but our audience have seen it many times as an opener for each and every one of our sessions. So, so maybe we'll start. I have a couple of questions. You guys have a presentation, but maybe you can share a little bit before, just a little bit more about yourselves and about the company, and we'll take it from there.
Sure, I'll throw up the start of the presentation just so we can go from there, and then we can go to the questions. That's great, Danny. Rob, do you want to start up?
Yeah, sure. So if you want to jump into the about us stuff, I can tell you the founding story. So as Denny said, this is my third startup. And do you want to go to the next slide, Chris? I think my bio stuff's on there. Um, yeah, this is good. This is my third startup. The first company I founded was called Backupify. We did backup for cloud computing applications like Google Apps and Salesforce. Sold that company to Datto for $115 million. I joined Datto as the head of marketing and business development. Then that company IPO'd for $4 billion a couple years later. I left and started a company called Tala. That company did customer support chatbots with natural language processing. We raised $18 million. It's still running. I stepped away a few years ago to join PJC, which used to be called Point Judith Capital. It was founded by a guy named David Martirano and a woman named Gina Raimondo. Gina is now Secretary of Commerce. She left a few years ago to become treasurer and then governor of Rhode Island. And I did all the AI and robotics investing for PJC. And this idea, Dianthus, was actually incubated at PJC. They wrote one of the first checks in and have been very supportive. In addition to this, I'm an angel investor in a lot of companies, and I write a very popular newsletter on AI. So I'll let Chris give his background really quickly, and then I can tell you a little bit about how the company got founded, and then we can get into the presentation.
Yeah, and I'll just add, it's pretty much, Denny hit it. 25 plus years, coming on 30, which makes me feel pretty old. Been lucky enough to be part of teams that have been brought on and/or the leader that's been brought on to take companies to the next level. Originally started in the enterprise software space back in the days of shrink wrap software with a company called Rational Software. That was when I switched over to tech. I was in heavy manufacturing actually for a while. That gave my first experience of being part of the transformation team of bringing Rational from a company of brands to a company of suites, which led IBM to acquire us for $2.1 billion. I was in the CRO of Constant Contact. Joined that, was pre-IPO, was 25,000 customers. And when we sold it 10 years later, and a great opportunity and great career and just great fun, we had 650,000 small business customers. We were 450 million in revenue, 1,500 employees. As Denny said, I was the CRO, and we sold that to Endurance for 1.2 billion. Took some time off and went to a VC firm here in town. I was their first EIR when they launched. Most recently, before Dianthus, I was the CEO of Buildium, and as Denny said, we sold that for 580 million. And when we landed at RealPage, for the year and a half that I was there, we ended up being the fastest growing division, the SMB division, for RealPage of 35% year over year, compared to about 11% for the rest of the organization. And it just talks about my love of scaling companies, my love of SMBs and how we can impact their lives and help them reach their dreams, and my love of doing that through technology. And as we'll hear a sec from Rob, all those things are very present here at Dianthus.
Yeah, and just to tell you guys really quickly, sort of why this came to be, we'll touch on all these points throughout the presentation. Basically, as a venture capitalist, I was looking at AI tools, machine learning tools for e-commerce, and came away with some of the points that you're going to see today, that AI is challenging for a lot of people because it initially underperforms the humans who do the work, and so it takes time. And particularly for e-commerce, I think a lot of the value, as a venture capitalist, I'm always thinking about where does value accrue as these new technology stacks emerge. And many times, you invest in a company that's 40% of the work and accrues only 20% of the value of that stack. And you really want the reverse. You want to do 20% of the work and accrue 40% of that value. And I think the problem with a lot of these e-commerce tools is even 20, 30, $40 million e-com brands typically don't have very built out tech teams. They still outsource a lot of their tech. Maybe they have a couple developers on staff. They definitely are not machine learning savvy. And I realized that a lot of what was going to happen with the tools I was looking at, there are tons and tons of opportunities to apply AI in the e-com world. It's becoming more quantitative. It's becoming more data driven. It looks more algorithmic, more like the path that stock trading went on over the last few decades. But the challenge you run into is that these tech teams can't do it. You need quant teams. You need the kind of people that haven't largely been going into e-commerce. And what's worse is, if we were going to build just software and sell it to these brands, I think it would be a challenging business model, because we would build models that would improve somebody's revenue by 3, 5, $10 million, and we might get $10,000 or $20,000 a year for that. I just don't think that's where the value is going to accrue. So that's where the idea came that we should model this off a company like Renaissance or Two Sigma, somebody who builds stock trading software, but not for us to trade stocks. So what Dianthus ultimately does, what you're going to hear, is we are a software company first and foremost. We are innovative. We are pushing the boundaries of what a lot of AI can do. But rather than sell our software to e-commerce brands, we acquire those e-commerce brands and use it to grow them faster and more profitably. And we have a lot of proof points around this. And when you see what it starts to look at scale, it's a really, really unusual business model because it gives you the downside protection of that you have in private equity deals where these things are unlikely to go to zero because they've been around for a while, they're already profitable, but we can grow them so much faster that you have upside like venture-like returns. So it's part of the reason we're so excited about it. So I'll let Chris start to take you through the opportunity.
Awesome, thanks, Rob. So yeah, so when we look at the challenge and opportunity, Rob just hit on kind of the three main areas. There's an opportunity in the direct to consumer or D2C brands in AI machine learning. And then we all, I'm sure, have heard about the growing space of what we would call the traditional aggregator, most notably in the Amazon space. So if we take each one first and walk through from left to right. So when we look at the opportunity, we know that there are literally actually tens of thousands of direct-to-consumer brands that are looking for acquisition. These are founders that maybe have essentially caught lightning in a bottle with a product that they're really proud of, that they've grown a nice business of upwards over $1 million businesses, and they don't know what to do next. They don't have the business knowledge. They struggle with this idea of building their business to the next level. And they get to a point where they say, look, I have this thing and I actually have my full-time gig, and here's my other brand that I've just built. And I want to find someone that will bring it to the next level. And they're thinking this way, like I said, because they've gotten to this level where they don't have money or patience or the volume of data to, when we talk about the AI machine learning opportunity, to benefit from that promise and that value from these AI tools. And then when you look at the machine learning landscape, as Rob just said, for these small to medium-sized e-commerce direct-to-consumer businesses, these things are really hard to deploy. You have to do it very deliberately. There's a lot of workflow automation. There's a lot of data tagging strategies that you have to take on. These are, 5 employee shops that don't have that knowledge. And they know, though, that the market in e-com and direct to consumer is actually pushing them to take on more technology, specifically around machine learning and AI, to automate many of their processes and to prove out from a quantitative perspective, the efforts that they're doing from a marketing, merchandising, and operations perspective. These are smaller businesses with very, let's say, limited and defined sets of data. And so again, AI machine learning tools and the tool sets and models that we're building require a huge volume of this data to really start to be trained and then to get that insight and to help you create the content and some of the activities that you're looking to do as a direct-to-consumer brand. So then when we were looking at that opportunity, of course, we ran into the traditional aggregators like Thrasio and like Perch. And there's literally, there's a huge amount of these players. Most of them today are in the Amazon space. And they're really focused on improving these companies through human interaction and not tech. They aren't focused on workflow automation. They're looking to drive efficiencies through the through the Amazon ecosystem. And they're actually their business model, because of the Amazon ecosystem, their business model requires them to buy a large volume of brands rather than having a focus, and rather than focusing on a quality brand and not, let's say, just a marketplace of a variety of products that they're trying to optimize the search algorithms in the Amazon space. So as Rob said, we from a Dianthus solution we're the software company that in the Shopify and WooCommerce ecosystem, we're the software company that buys, boosts, and builds direct-to-consumer brands. So we're looking to buy Shopify and WooCommerce brands. We like that because it gets us actually the first party customer data, as opposed to the Amazon space, which you have very limited access to deep first party data. We're very focused on the pets, beauty, home, and sports active focus. We chose those 4 verticals for a very deliberate reason, because we think there is a great deal of same consumer behavior and similarities between, even at the data level, that we can augment the data model through pets activities, beauty activity, home activity, and then build a really, really strong machine learning customer data platform. And we're going to fully acquire these brands so that we can drive the deployment, the workflow automation, and the data tagging that's necessary to feed into the data models that we're creating. So again, as we talked about, the solution involves not only people helping these brands, but most certainly at the cornerstone is the proprietary AI machine learning models that we're developing. So our AI tools are going to automate marketing and content generation. Our machine learning models will optimize the pricing, cross-promotion, checkout, and couponing all through the stack of the business. Those will be available to all of our brands. At the same time, we will build out brand-specific, that Rob will talk about in a second, brand-specific machine learning models for individual brands to help them either on the top line growth or improve their bottom line from a COGS perspective. And so with these first two columns that I talked about, we see that there's an opportunity to truly upend this category of aggregator. We're coming at this as truly a software platform, and then adding on the idea of acquiring the tools. So we're truly a hybrid, or acquiring the brands, truly a hybrid. We're looking to boost the brands like the other aggregators are doing through human interaction, through subject matter experts, helping these brands become better marketers, merchandisers, and operators. But the second part of our secret sauce is this machine learning and AI platform that our tech team is developing. The other very key thing here is, as I said, many of the aggregators today are focused on improving the bottom line through improving capital efficiency at the COGS line. What we're looking to do with our tools is to accelerate their top line revenue growth, then also improve their capital efficiency, which will help lead to customer acquisition costs being brought down, which will make them overall a better business. As I said, we're for vertical focus. And why are we doing that? So in these verticals, again, we're looking at Shopify, WooCommerce, and BigCommerce brands because we can get at their customer data to feed our machine learning models. We're focused on $2 to $20 million in revenue, EBITDA positive. We are not looking to acquire brands that are in distress and help them recover. We like this because we also like this area because they have some unique and interesting data sets. For example, our first major acquisition is a company called Cuddle Clones, which makes custom plush versions of your pet. They literally have a data set of hundreds of thousands of records related to pets. And all things around pets, birth dates of pets, if the pet's passed away, what their breed is. In addition, there's also a ton of photographs there as well. So that uniqueness will help feed our huge machine learning model, which allows us to then create models to execute programs, not only in the pet space, but also we think cross-promotion areas in some of the other verticals. By having this focus, we believe that it's going to create a market defensive ability. It's going to increase our customer lifetime due to the expansion of wallet activities that we are going to be able to do with all of our consumers across those 4 definite verticals. And we'll be able to organically grow through just savings because we'll be consolidating and bringing all these brands together. There'll be many benefits as far as a volume perspective around purchasing, around operations, around fulfillment, et cetera. Again, part of upending the aggregator space here is this idea, I've said it a number of times already, but it's important, the access to the first party data. This is something that folks cannot get in the Amazon space, but we get down to the actual customer record with the history of purchase, the history of behavior on the websites, et cetera. We get all of that information that you cannot get in the Amazon space. And ultimately, we like this idea of vertical integration. So as Rob talked about, because we have the ability to see from top to bottom of the funnel through the entire business stack, we are not only going to be focused on, let's say, the top of funnel and all the data there, we'll be able to close that loop with our machine learning models and build even stronger models, because we'll be able to get at the entire customer journey, which is what some of the AI point product solutions are struggling with, we know today. Rob talked about this. We love this model because we think it's awesome all the way around, with many, many risk minimization opportunities across the board. From this idea of the downside risk that Rob talked about from a PE perspective, we're also, as we talked about, building custom machine learning software specifically and only for the brands that we acquire. So this proprietary platform and software stack, we're not going to sell that software. As Rob said, from an economic perspective, it didn't make sense. And we can control the entire experience by acquiring those companies. And as we kind of hit on all these benefits already: better data collection, vertical integration, diversification across all of our e-commerce brands, but feeding into a very strong customer data platform. And it allows for extremely fast growth while also staying profitable. So we've been asked by a number of folks, so, okay, great. We're seeing the competition really kind of heat up on the Amazon space. What are you seeing overall in the Shopify and non-Amazon space? So today, just to run through some numbers to give order of magnitude. Today, the e-com revenue in the US is $875 billion. There are 875,000 US Shopify merchants. There are about 60,000 Shopify stores in our target. Some of them are looking to sell. Some of them are thinking about selling, and some of them will have to warm up to look at selling. And there are 475 million people buying from Shopify stores today, or as of 2021. So again, just from a data perspective, when bringing together the brands that we're acquiring, that will allow us to really create something unique, special, and proprietary that will help us create content, help us understand insight and consumer behavior, and help our brands become better marketers, better merchandisers, and better operators. We talked a little bit about the Amazon versus Shopify space, and really what it boils down to is we're hearing more and more, and what we knew going in was, the Amazon space is more and more a marketplace versus Shopify brands, which are actually brands. Founders have gone to Shopify looking to build a business through differentiated products and create a very unique brand identity, as opposed to an Amazon where more and more it's a marketplace type of pass-through. They aren't differentiated products. They are probably not manufactured specifically for that brand. They're labeled with a company name on it. But there is definitely a difference between, hey, I want to build a company from a brand perspective, or I want to sell a bunch of products through a marketplace perspective. That's what we're seeing on the Amazon side. Again, Amazon offers you a very explicit playbook and deliberate playbook as to how to optimize your business. And these aggregators are taking advantage and working through that playbook. Amazon takes a lot of fees from selling on their platform, and those fees are actually increasing. And as you talked about before, there's very limited access to detailed customer data. And that's why, again, we love Shopify. We have very passionate brand builders who are now at this next level, and they're looking to sell. And it's very important to them that the company to whom they sell will maintain, build, and accelerate their brand identity and their brand presence. The optimization strategies for Shopify are across the board, all stacked from a business function perspective, marketing, merchandising, fulfillment. And we, again, hope one of the big takeaways that you're taking from this is that Shopify allows us to get to the volume of data and the level of data that we need to really train and build our machine learning models. So wanted to talk a little bit about something that happened that was put in place last April that has really challenged direct-to-consumer brands that actually has turned into an opportunity for us. And there's a phenomenon going on that actually didn't happen historically in, let's say, a B2B type of situation when, let's say, a marketing channel kind of went bust. In the past, from a B2B, business-to-business type of marketing and business growth, there have been marketing channels that have been challenged and essentially gone bust. And and many of the B2B marketers, I was one for quite some time, said, okay, now I just need to find that next channel because my market is still there. I just need to find the next way to activate them. And to both create and capture the demand from the market. So, historically, from a direct-to-consumer perspective, Facebook has ended up being the overall number one, in many cases, only marketing channel that these growing direct-to-consumer brands have used. There's very limited activity in other newer or even traditional type of marketing channels. Instagram, TikTok as the newer ones, email marketing and the offline as some of the traditional ones. And so we come to find direct-to-consumer brands that are really mono-channel and grew their business very well on the back of Facebook ads. In April of 2021, the Apple introduced their Do Not Track function, if you will, on iPhones. And this one overnight impacted our direct-to-consumer brands, their ability to segment and target audiences. So all of a sudden, these direct-to-consumer brands thought, my God, my market has gone away, because they didn't have, and they don't have, the knowledge, the understanding of how to use these other marketing channels, other than, for example, email marketing for them equates to transaction emails for purchase confirmations. So this immediately impacts customer acquisition costs for these direct-to-consumer brands. Facebook now takes more activity and time and money to get at those consumers. And now new and expanded marketing channels at scale with massive personalization is actually going to help bring down that customer acquisition cost again. And that's right where we are focused around developing our AI tools and machine learning models to help these direct-to-consumer brands expand their channels, get to scale very quickly, get to massive personalization. Rob says this all the time. Yes, it is a tough thing that happened in April, but this is a great machine learning and AI challenge for us to get after. Rob, do you want to jump into the AI challenge?
Yeah, so I'll talk a little bit about the AI challenge. And one of the things I hear a lot when I talk to people is how people think about AI. Some people think it's bullshit, some people think it's overhyped, and some people think it's actually magic. And as somebody who's spent a lot of time in this space, I first encountered AI about 20 years ago. I started a master's degree in computer science focused on AI and decided not to finish back in the early 2000s because at the time it wasn't really going anywhere. But since then, I ran a previous AI company, and then I've made about 110 angel and VC investments, and probably 85 or 90 of those are AI related. So I've seen a lot of stuff of what works and what doesn't. And these are all three valid perspectives on where the industry is today. There is a lot of bullshit out there. There's a lot of people calling things AI that are statistical methods people used 30 years ago, and it's just marketing hype, and it gives the industry a bad name in a lot of ways. There's also a lot of hype. Oh, can you go back, Chris?
Yeah, sorry.
There's also a lot of hype with some of the things that come out that you read these research papers and they did this like amazing thing in the research paper in the Stanford lab or in the Facebook AI lab or whatever. And we've tried some of these things, both at this and other companies. I've tried some of this stuff and we can't get it to work in any production level system. It's just not ready. But there's also some real magic, which we'll talk about. There's some things that work and are surprisingly good and are underappreciated. And as you can imagine, they tend to be the things that take a while and the things you have to grind through and solve the edge cases just like you would anything else. But they're really, really powerful when you solve them. So now you can skip ahead.
Yeah, Rob, if I can just jump in for this was actually almost the exact type of conversation I had with you when we were thinking about joining, when I was thinking about joining Dianthus, right? Wanted to make sure, just coming from the marketing world, even when I was in it, there was a lot of hype around putting AI on anything. Knowing where you stand from an AI perspective and your skills, it was very quick that we got through the bullshit hype and magic well. So it's awesome.
Yep. And this is a private slide from a company I'm invested in called BotKeeper. And what BotKeeper does is they automate accounting tasks. And then you can see on the right-hand side is the gross margin percentage. And it's that light blue line that's gone up. So you can see back, they didn't even extrapolate it all the way to 2016. When I invested in 2016, this company had like 24% gross margins. And I showed it to a whole bunch of venture capitalists at the time. And they all said the same thing, like, Rob, you're dumb. This is a services company. You're going to lose your money. It's not going to scale very well. But BotKeeper was grinding it out and recording the tasks that their accounting team did. They had this accounting team in the Philippines that's trained in US GAAP accounting. And if you were all online, Expensify, QuickBooks Online, NetSuite, or whatever, they would take care of everything for you. Your journal entries, reconciliations, bill pay, all of it. And the challenge with so many of these machine learning opportunities is there's places you can automate, there's places you can build predictive models, but we don't have a data set to do it. So what BotKeeper was focused on for that first year or two was capturing the data set. And now you can see, they've raised, their last valuation was over $500 million. And they did this, they scaled, they've laid off some of their accounting staff as they've scaled because they've gotten so efficient. And now you can see at the end of 2020, these are even better now. They had software-like margins. They had done it. It just took some time. The next slide, Chris. Here is an example of something that actually is, I think, magic, which is pretty amazing. One of the trends you're starting to see in AI, and one of the things we're doing a lot of at Dianthus, is what we call multimodal AI. So it means instead of just training a bunch of machine images, or instead of just training a bunch of text, you train text and image together. So this model is called DALL-E 2. It's the second version that came out, which is why it has the number 2. And it is a text to image model. So they trained hundreds of millions of images with descriptions of those images. And what it allowed you to do was now give it a description of an image that does not exist and create that image. So what you see on the left here is the input. Somebody said a bowl of soup that is a portal to another dimension is digital art. And DALL-E came up with these 4 images, which are not images it found anywhere, right? This is not search, this is actual content generation. Now, there's some really funny ways to break this model, right? It's not perfect, but the reason it's important, because what we'll talk about in a bit is Dianthus does a lot of automated content creation. That's one of our goals. And as you tie it all together and you know more and more about your customers and their buying, you're seeing all the levels of the stack, the vertical integration from top of funnel through purchasing behavior and post-purchasing behavior, cross brand, you're really able to do a lot with the content generation based on what you know about a customer's preferences. And so there's a really interesting question that people always ask, like, why us? Why me and why Chris? And why aren't a bunch of other people going to do this? Why is Thrasio doing this? Why don't these brands do this? This chart here comes from a book called Competing in the Age of AI. It's written by a guy named Karim Lakhani. He's a professor at HBS. And it highlights another version of what you saw in that BotKeeper slide, which is when people go to apply AI, the AI almost always loses in the beginning, and it loses for a while. It takes human input. It's like training a person. You have to teach them what to do. You have to correct their mistakes. And a lot of people don't have the stomach for it when you're running tight and you're like, we got to be efficient. You don't have somebody you can pull off and be like, can you go label 2,000 pieces of data so we can do this? But over time, we have a lot of data that supports this that we can show you. The digital operating model will crush the traditional operating model when it starts to scale. We're already seeing some of that. So next slide, the Dianthus AI story. How do we use this just at a high level? A lot of vertical data integration, seeing what somebody does at different steps along the funnel, knowing a lot about them, automating every function. I think about every task and how it can become a machine learning model so that humans don't have to do it. That improves margins, it improves speed. And then human augmentation. There's still a lot of things that AI can't do and won't be able to do for many decades, but you can build models that help humans make better decisions. And a lot of this is, some of it's a little bit counterintuitive because you have to do things like you have to build an interface that captures some of the workflows that people are doing, like BotKeeper did. So anyway, so we can do that.
Sorry, I don't know why I keep jumping.
Nope. Yeah, no, that's in. Go ahead.
Okay, so just wanted to give an idea. We wanted to share where we are along the timeline. We really have been executing on our business model since, I would say, last October, from an overall perspective, and that was when we put out our first LOI in Q3 of last year, end of Q3, beginning of Q4. And that was the acquisition of our first company called Color Clones that I referred to previously. At the beginning of the year, we've announced our $11.5 million seed round, and then in turn finalized all of the integration of the Cuddle clones into Dianthus. And with the acquisition of Cuddle clones, as Denny referenced, we ended the year of 2021 with a $50 million from a revenue perspective, with the plan to get to 100 million annualized revenue for the end of 2022. And so we started working, and things are moving really well as per the proof points that Rob referenced that we're proving out. We have a set of 7 proof points of proving out our model at each stage. And so we've moved to now 3 more LOIs. We've actually added a couple of more since we put the slide together. We've confirmed and got approval for a $22 million debt term sheet with WTI. And now we have about $30 million in revenue in annualized revenue in the LOIs that we have in play today. And presently we're working on, we'll talk more about this, our $5 to $7 million round that will allow us to unlock even further debt as the acquisitions are put together based on debt. And I'll take some time to talk about how we're structuring our purchasing deals with the brands. And so the greatness is, as we're proving out these points, we have a financial plan with our EBITDA being on plan. We are on goal as to proving out that we can get to an LOI and work to then continue to close those. We did have a slight delay in some of the brands getting actually acquired just because of frankly, the machinations that we had to go through to get our debt set up and established. So let's talk a little bit about what we're seeing from an acquisition multiples, and this is where I'll talk about our structures as far as purchase perspective. So direct-to-consumer brands are based on a multiple off of EBITDA. We have our target segment of $2 to $20 million, and we're seeing an average of about 5.5 times 12-month trailing EBITDA from a multiple perspective. And across the spectrum, though, that 5.5 is an average. Multiples, top end of our target, we're seeing a higher multiple, seeing lower multiples at the bottom end of our target. And we're definitely seeing, because these are, let's say, few product brands, 1 or 2 or maybe 3 products, there is not a great difference in composite that you have to look at from a margin perspective. So as that brand grows, if they're EBITDA positive, their scaling kind of goes with it. And so we're seeing that the EBITDA goes with it as well. So that higher multiple we're seeing at the top end, really seeing a higher EBITDA that goes with that larger revenue base. From a competition perspective, reference this a couple of times, we're definitely seeing competition in the Amazon space, but not yet in the Shopify space. This is still stake your claim kind of wild, wild west in the Shopify space. And the cool thing is this opportunity is large enough. And when we talk about our financial model, you'll see the number of brands that we need to get to our goals. This opportunity is large enough to have many nicely sized businesses, all of different models, in the Shopify WooCommerce ecosystem. We see 2 smaller, we know of 2 or more smaller, and they're focused on more smaller customers. In the vast majority of the deals that we're going through right now, we are actually the only company within working with the brands to acquire them. So we're not seeing competitive bids. We're not seeing competitive situations. 2 of the main competitors we're seeing is OpenStore, which is really focused on the smaller D2C brands, and Hedgehog, which actually is here in Boston, and that's focused on helping distressed brands, acquiring distressed brands and then building. No other company that we're seeing today is coming out with this mixture of AI and data, or leading with AI and data complemented with subject matter experts. Our purchase structure is where we are looking to set out the purchase deal in 2 or 3 tranche cash outflows. And so at the time of close, and preferably it's structured 1/3, 1/3, 1/3. So at the time of close, we will outflow a cash amount of 1/3 of the purchase price. A year from then, another 1/3, and a year after that, another 1/3. And the model is such that as we start to get the improvements into the brand, we believe the cash outflows that we are seeing from Cuddle Clones, as an example, ultimately the brand cash outflows from the ongoing brands will actually be able to pay for the follow-on tranches, and so that all the new debt that we will get is really focused on continuing to acquire cohorts of brands over the years. And here's our model. So the first thing I want to point to you is we are not talking about we need thousands of brands to reach our overall revenue goal by the end of 2025 of $1.3 billion with 350 million in EBITDA. If you add up those companies on the right, the numbers there, that equates just to about 100. And so we feel most certainly in the space of $2 to $20 million in revenue, EBITDA positive, growing brands, excited founders that are looking to find somebody that will take their baby, if you will, into good hands. We believe we have 100% the ability to find that amount and hopefully more by the end of 2025. For this year, we're looking to acquire 10 brands, as we talked about, leading us to be a $100 million annualized revenue business, and about a $5 million annualized EBITDA business. And then we have this idea of escape velocity. And escape velocity is really, hey, when do we know if the flywheel is really happening and that we can stand on our own and that we don't have to go through a Series C, D, E, and F, but that we have a business model that is strong, that we as a company can service and work to drive massive customer value over to our brands. And so there's two aspects to that. Three aspects. We're looking to be operational EBITDA positive by the end of, or into the second half of 2022. Again, I just want to throw out there that this is just 9 months after really starting to execute on our business model. On top of that, cash flow positive in 2022, 9 to 11 months after our business model execution. And this idea of, we're building out the team right now, but as we go through, we have this goal of, we want to make sure we'll be tech position heavy, if you will, by design because of the AI and machine learning models we're developing. But overall, the corporate overhead will remain well below 10% as we get into 22 or 23 and beyond. This is the team, building out the team, bringing on folks that have e-com experience, SMB experience, scaling companies experience, and obviously from a tech perspective, we have brought on some serious heavy hitters from the AI and machine learning world. And that's because they know Rob and they know what Rob has been able to do, and his understanding of let's get after true AI and rip away this kind of presentation layer of AI, and let's really live into that magic that Rob talked about. So we have an opportunity here that we'd love to share with you. So as we talked about, we closed the $11.5 million seed round. We've secured a $22 million debt facility with that first tranche leading to us to be able to close some new acquisitions. The opportunity at hand is we are filling out a $5 to $7 million round at an $85 million post-money valuation. Just to note, the $11.5 million seed round was a $41 million valuation. This will, as I talked about, will unlock probably four acquisitions en route to a Series A target of $30 to $40 million later this year.
Yeah, and just to be clear, well, yeah, and I would just add to this, part of the reason that we decided to do this interim round was because the fact that our debt provider sort of said, with a little bit more capital, we'll give you a little bit more debt. And just from kicking the tires on the Series A discussions, we think we need to close 2 to 3 more acquisitions to really have the proof points to show that we could scale into this for the Series A providers. So we talked to the board about it. We've got about $3.5 million sort of committed already. And we're just looking for people that might be interested in sort of finishing out the round.
Right. So we, from this round perspective, we have a peg of a minimum investment opportunity in general that we've communicated for folks of $500,000 per investment. But for this for this audience, hopefully folks are going to be super excited about this opportunity, as excited as Rob and I and the rest of the Dianthans are excited. And so we'll definitely reach out if you are interested. If 500 is not something that fits into your model, we are most certainly happy to discuss further to see if we can come up with something creative.
Thank you. So we had I had some questions, but we're basically almost nearing been almost an hour. But first of all, there were many questions here. Some of them you answered yourself. So first of all, out of those questions, maybe there was some that you think you should share with others. If so, maybe you should address them here so everybody can hear. So Rob, I know you've been following the different questions. I will remind everybody that yes, we record the session and everything here. You'll get a link by tomorrow with a link to this session. But I'm just saying, Rob, you had a lot of questions from folks. Is there anything that was asked and you guys didn't talk about that you want to share?
So I don't know, Dave, thanks for that. I don't know if my answer around the valuation tool for Shopify came through. So that was from Amit B. So Amit, yes, we are actually working on that, and something we're excited about. We've seen already the output from Rob's tech team, and it's super exciting. And what I will say again is, for many of these valuation tools, or any kind of these tools, I go in and try to break the tool to say, oh, are you just throwing me into some silly segment? And if I change it up, you're going to give me the same answer. But from this model, every single time I tried to break it, it was actually really personalized to just me based on the variables that I put in. And so that's super exciting. And we know that many of the brands actually have asked for this. And so we're working on it. So thanks for asking that question.
Yeah, and then one question that we've gotten a lot, nobody's asked it yet, but I will give you an example of, can we show how we've applied AI to improve a brand that we've already acquired? So Cuddle Clones had a product where you upload a picture of your pet and we can airbrush out the backgrounds. We just have the pet head and we can print that on a pair of pajamas. Cuddle Clones will sell 200 to 250,000 pairs of pajamas this year. And that airbrush process costs $3 per pair of pajamas. So in about 6 weeks, we built a machine learning model that removes the background on its own. It runs in 2 minutes. It'll translate to about $750,000 directly to the bottom line of Cuddle Clones. And that's on a business that'll do $25 million this year. So it's pretty significant profitability impact. And that's one model. And it's something that the Cuddle Clones team had actually thought about and tried and were sort of not able to make work on their own, that we pulled off pretty quickly because, as Chris mentioned, we have a very, very strong and talented AI team. And it's getting stronger. And if you're an investor in a lot of tech companies, you probably hear how hard it is to hire those people. And we have 100% success rate on closing candidates so far, and have way more than we can handle. Chris, you want to answer the questions about the debt terms?
Which one is that, Rob? Sorry, this is of our debt provider. Sure. So there is. So again, the debt provider is WTI. We have, at the time of close, from a terms perspective, we have the $5 million in immediate debt available. Part of the closing of this round will get additional $2 million, and then the $15 million will be released as part of the Series A tranche, or when we close the Series A. There are warrants. There are some other covenants. The warrant is, I think, between 2.5% or 3%. And there's a little bit of variability for some other terms depending on the length of relationship with WTI. So if we stay with them for a year, if we stay with them 2 years, the terms improve, frankly, and fluctuate.
Yeah, and we don't anticipate staying with venture debt over the long term. It was the right fix for us now after we've talked to a lot of different types of providers. But I think as we cross $150 million in revenue, I think we'll be able to go and refinance that with other types of debt, mezzanine providers, lower cost of capital, some bank debt. We've talked to a lot of the players. We just weren't quite there yet.
And I'll just add to that, many of them have a very distinct model of either, hey, this looks like an aggregator, or hey, you look like a software company. And here we come in saying, no, we are upending the aggregator, and frankly, upending a software company. We're right down the middle. And so for some of the debt providers, they're just like, we can't even we don't know how to structure that. And so that was great that WTI understood and valued our new type of model that we're going after.
Thank you. I guess, a question from me when first of all, I'll mention that next week on the 27th, which is Wednesday, we're doing our conference at the World Trade Center. You guys will be there as well.
Yes.
Right? Yeah.
Yep.
We have great speakers from Bronfman to Silverstein to David Sable, who was the chairman of Young and Rubicon, and many others. So look at that. You can find it at nyc-wealth.com. And at the evening, we're doing a private dinner that we're holding with you. So if there's anybody here that would seriously consider learning more and getting involved with the opportunity, they definitely can join us. They just need to maybe write us an email about that. And maybe a question I have for you, I had a discussion, and maybe if you can get out of the presentation. Well, yeah,
You got it.
I had a discussion about it. Just 2 days ago, we did a session with Silvertech, which is the tech investing arm of Silverstein, and we spoke about, markets that were dominated by one player, and back then you didn't dream that anybody could deal with them, and nobody remembers them today. Netscape, AOL, and then came somebody else and just stole the market. It was now when you look at Amazon, I mean, this is a little bit more difficult. You got a firm that rules the earth. They have very good reason to do that because they have amazing customer support. Like really, I've been dealing with them forever, and they take care of their clients. They got, of course, all the storage and all the facilities and all the trucks to get to you from today till tomorrow morning, which is, and I think that's something you cannot really compete with that easy because this is heavy machinery there. And they got everybody. So do you think that, and obviously, of course, AI, it's needless to say, COVID got more people to do online got more into AI, understanding the clients and working better. That goes without saying. But do you think when you're looking at someone like Amazon that could also change at some place? Somebody can take over because at that kind of size, who can fight with these guys?
Rob, do you want to take that? Because I know
Yeah.
it's a great way to answer.
It's part of what prompted me to start the company was, and I just dropped this in the chat. When I was looking at the space as a venture capitalist, if you're going to make a long-term bet, and just to be clear, we entirely intend to IPO this company. And if you're going to make a 10, 12, 15-year bet, I think you're betting on Shopify versus Amazon. And there's a bunch of reasons for it. As Amazon's growth slows because their e-com market penetration, they run into this challenge of the best way for them to keep juicing their stuff. And you've seen this if you look at the data, is to take more from their third-party merchants. And so you're seeing more brands like Allbirds that won't sell on Amazon at all. You're seeing people complaining about Amazon competing. You have a movement of all the people that are much younger than all of us who don't want to buy from Amazon because they don't agree with what the philosophy of those, like the wave of e-commerce in the future is very much about what these brands stand for politically, socially, environmentally, all that kind of stuff, how they treat their workers. And, having the ability to have those front-facing direct-to-consumer brands, I think is really important. Not that Amazon's going to go away, but I think their dominance and their hold over the market is weakening. And there are a lot of forces that are moving in the favor of Shopify.
And when you look at the different scenery, eBay, again, same story. They are the biggest player by far than anybody else in their market. They also have great customer support, and they take good care of their clients. And you can get them on the phone in seconds. So they also managed to build a very, very strong platform. But then you see all these guys, Mercari and all these smaller folks. Well, Mercari are very big in Asia, but here at least trying to get into their space. I don't think it's easy for them. How do you see that space? Do you see eBay disappearing at some point as well? Could be. Are they getting? What trends do you see there, for instance?
Yeah, so I would think about it a different way, right? Which is e-commerce is going to become more and more fragmented, the way that marketing has and everything else. And what that means is the way you respond is to be more automated, so that you can scale faster, you can change faster. It's like if if TikTok pops up and you have to have somebody go in and understand TikTok and figure out how to create TikTok content, and if you do this in addition to everything else that you're doing, it's really, really hard for small firms. And it's something that Amazon doesn't care about because they're a juggernaut that's kind of going and going. But I think I think for us, the big insight, if you've been to business school, you spend a lot of time on economies of scale and not a lot of time on economies of scope. And the big insight that I got from Kareem Lakhani's book was this idea that in a digital world where data is your key asset, economies of scope can become economies of scale. So doing different things, whereas we would have learned in business school, when I went 20 years ago, hey, look, you can't be in too many businesses because you got to focus and it's all about go to market. But now the data from those different businesses can complement and enrich each other and make each business better. So economies of scope become economies of scale. I don't think that's something they're teaching in business school yet. It's an insight that I've had because I've invested in 100 different, AI related companies, and people that have been watching this stuff. Like when I talked about this to Chris, like the light bulb went on and he was like, yes, exactly. And everybody that hangs around this company, me included, I didn't intend to come do this full time when we seeded it at BJC, but like, I just fell in love with it. The opportunity is so big. So that's how I would think about it, is those companies are going to stay around. The fragmentation is going to continue. Managing that fragmentation operationally is best done with computers and algorithms. And that's what we're doing.
Yeah, and if I can add to that, Denny. So, if you think of, to bring up the three, like Amazon, Etsy, and Shopify, you are known as an Amazon seller, you are known as an Etsy seller, you are known as a Shopify brand. And that, for the founders that were going, so there is, again, I think, space for all three. The Shopify aspect from an aggregator, hybrid, accelerator, us, is just starting. The view that Shopify has towards this type of a model from traditional aggregators, and then what we're talking about, is a positive one. Amazon has kind of a back and forth from a view as to the aggregators, and eBay doesn't really have that idea. But Shopify, we know they're positive on it because my former CEO from Constant Contact is on Shopify's board, and it's not by chance that Shopify looks at their customers and calls them brands, because there's a whole different aspect of building a brand and building the business as opposed to being a seller in both Amazon and Etsy. And that's very important for the folks who chose to go to Shopify. I want to build a brand with differentiated products and grow it to my ability, and then see where I go next and how do I go next, and where the answer to where they go next.
Got it. Thank you. And I see more questions, and I see you're answering everybody here, Rob. Yeah, I mean, I see people still ask questions, so maybe I'll ask another one of mine, so we'll have some more time for anybody who has more questions. And again, we will send you the contact info of Rob together with the link to the recorded session. I'm trying to choose from the questions I have here, which ones you've talked about already. If you're deploying AI everywhere in the company, how do you decide when to buy a tool and when to build something yourself from scratch, really?
Yeah, so it's a great question, because there's a lot of tools out there. Some are targeting really big brands, some are targeting small brands. The ones targeting small brands are struggling, frankly, because of what we talked about, small brands. And the big brands tools get sort of sucked into the needs of the big brands and everything else. And so the way that we think about it is, there are use cases where the data across lots of brands horizontally is really valuable in building machine learning model, and data vertically. So, seeing the top of funnel data and the middle funnel data, funnel marketing data, bottom of funnel purchasing behavior, shopping cart abandonment, etc., is valuable in building a model. When it's deep, when it's vertical integration, we almost always build, unless there's some cost or expertise reason that prevents us. Otherwise, when it's horizontal, we buy. But what this means that we haven't talked about is when you think about the things that we should get into in the next couple of years, given the data sets that we have and that vertical data integration model, loyalty and rewards programs across all our brands and within brands, afterpay, our own afterpay, kind of data. Like we'll just have this sort of data-driven e-commerce first approach. I think is really going to be powerful.
Very, very interesting. Yeah, I mean, we see many companies here, as you can imagine, doing what we do. And I really think this is a very interesting and unique model and story behind this, what you guys do. Anything else you'd like to add before we finish our session?
I would just add, I look forward to seeing whomever's going to be at the conference next week, and then folks that want to join the dinner. And then I'll just add, as Rob said in the chat, I think Rob and I have been, through hard work, been pretty fortunate to have some really, really nice experiences in our professional careers. And both of us have said, this has the opportunity to be the biggest thing that we've ever done, from a scaling perspective, from a returns perspective, and frankly, from an impact, a lasting impact perspective, because we're building a model here that doesn't exist today. And we're already seeing proof points, again, 6, 7, 8 months into executing on the model. So that's super exciting.
Yep.
Got it. Well, great. And don't rush to invite people to our dinner. We might be sold out by now, but I'm kidding.
Okay,
But,
sorry.
if anybody's interested, let
That's
us
a good
know.
thing.
Of course, if anybody's seriously interested in getting involved, then we will make it work. So just let us know. Great. So I'd like to thank you all for being here. And yeah, and we're getting ready to see our tri-state folks. As you know, we are all around the place. But next week, our tri-state folks mostly at our New York conference at the World Trade Center. And thank you everybody for being here. And I hope Chris and Rob will see you after the summer at our other events throughout North America and the world. Thank you very much for being with us today, and everybody enjoy the weekend that's coming very soon your way.
Awesome.
All right. Thank you
And
guys.
enjoy
Thank you, Jim.
Florida, Rob. We envy you. You know,
75 degrees right now. I'm just saying.
this is not fair. I'm stuck in a weekend. My wife goes to Washington with her family, and I'm stuck. Well, not stuck with the kids here in New York. It's colder, but we'll do fine. Thank you, everybody.
Thanks, thanks, Danny, for helping us put this together.
Thank you. Bye-bye.